Could Donald Trump's re-election be the game-changer Social Security needs? His bold promises, from eliminating taxes on benefits to fixing unfair penalties, have sparked serious discussions. But with the Social Security Trust Fund projected to run dry by 2033, can these ideas really make a difference, or are they just campaign rhetoric? In this video, we're breaking down Trump's proposals, exploring recent legal changes already reshaping Social Security, and analyzing the looming crisis that could impact your retirement. Stick around to the end to discover what these shifts mean for your financial future and how to prepare for what's coming next. Welcome to Financial Area. If you're passionate about securing your financial future, make sure to like this video and subscribe for more insights that matter. Donald Trump's campaign has brought renewed attention to Social Security, particularly with his promise to eliminate taxes on benefits. Currently, Social Security benefits are taxable for individuals with higher incomes, with up to 85% of benefits being subject to federal income tax if certain thresholds are met. This taxation has been a source of frustration for many retirees who argue that they already paid taxes on their income while working. Trump's proposal to remove these taxes aims to provide financial relief to retirees, allowing them to retain more of their benefits. However, implementing this change faces significant challenges, as Congress would need to approve the elimination of this revenue stream, which contributes billions to federal funding each year. The feasibility of this promise depends on political will and broader budget considerations, making it a key point of debate in his campaign. Another aspect of Trump's vision for Social Security focuses on addressing penalties for individuals who work after claiming benefits early. Under current rules, individuals who begin receiving Social Security before reaching full retirement face reductions in their benefits if they earn more than a specific threshold from employment. For many, this creates a disincentive to work, particularly for those who might need supplemental income in their early retirement years. Trump's approach suggests that these penalties could be revised or eliminated to encourage work and allow retirees to benefit fully from their earnings without fear of deductions. This policy aligns with efforts to support older Americans who want or need to remain active in the workforce. While less prominent than the promise to eliminate taxes on benefits, addressing these penalties could offer practical and immediate relief to a significant portion of Social Security recipients. A significant recent change in Social Security law has addressed a long-standing issue affecting government workers. Historically, government employees who worked in the private sector and paid into Social Security often found themselves subject to a reduction in their benefits due to provisions like the Windfall Elimination Provision, WEP, or the Government Pension Offset, GPO. These policies were designed to prevent individuals from receiving full Social Security benefits, in addition to their government pensions, but many argued they created an unfair disparity. In a move that garnered bipartisan support, Congress passed legislation to eliminate certain penalties for these workers. This change means that government employees who contributed to Social Security through private sector jobs will no longer face the same reductions in their benefits, allowing them to receive a fairer calculation. The adjustment is widely regarded as a step toward addressing inequities in the system, especially for workers who split their careers between government and private sector employment. This shift not only impacts the affected individuals directly, but also demonstrates a willingness to correct systemic issues within Social Security. It reflects growing recognition of the need for fairness in benefit calculations and could pave the way for additional reforms. For those who previously felt penalized for their work history, this legal update provides a much-needed boost to their retirement security, highlighting the importance of continued advocacy for fairness within the system. The Social Security Trust Fund is facing a dire crisis, with projections indicating it could be depleted by 2033. This looming depletion means that without intervention, Social Security would only be able to pay benefits from its current revenue, which would result in an estimated 20 to 25% reduction in payments for all recipients. For millions of Americans who rely heavily on Social Security as their primary source of income in retirement, such cuts could lead to significant financial hardship. the situation has created an urgent need for reforms to stabilize the system and ensure its long-term viability. One potential solution frequently discussed involves raising the salary cap on Social Security taxes. Currently, income above a specific threshold is not subject to Social Security taxes, which limits the revenue collected from higher earners. By increasing or eliminating this cap, the government could generate additional funds to shore up the trust fund. However, such changes are often politically contentious, as they would increase the tax burden on wealthier individuals, making bipartisan agreement difficult to achieve. Beyond structural reforms to funding, the crisis highlights the importance of individuals planning for uncertainty. With the future of benefits unclear, retirees and those nearing retirement are encouraged to consider worst-case scenarios when preparing their financial plans. This might include saving more aggressively, delaying retirement to maximize benefits, or diversifying income sources to reduce reliance on Social Security. While the government debates solutions, individuals must take proactive steps to mitigate the risks posed by potential benefit reductions. The trust fund's depletion serves as a stark reminder that the system, while essential, is not immune to financial challenges and requires careful navigation both at the policy level and in personal planning. As the future of Social Security hangs in the balance, it's clear that the stakes are higher than ever. Donald Trump's proposals, such as eliminating taxes on Social Security benefits and addressing penalties for early retirees who choose to work, represent bold attempts to reshape the system. However, their feasibility depends on political negotiations and the broader economic context, making their realization uncertain. Meanwhile, recent changes in Social Security law, like the elimination of penalties for certain government workers, provide hope that reforms can address long-standing inequities, but they are only a small piece of the puzzle. The most pressing challenge remains the looming depletion of the Social Security Trust Fund by 2033. Without intervention, benefit reductions could leave millions of retirees struggling to make ends meet, underscoring the urgent need for bipartisan solutions. Proposals such as raising the salary cap on taxable income could stabilize the system, but these measures come with their own political and economic hurdles. For individuals, the uncertainty surrounding Social Security reinforces the importance of proactive financial planning. Preparing for potential changes, whether through saving more, diversifying income, or delaying retirement, can provide a safety net in the face of unpredictable policy shifts. While no single solution will resolve the crisis overnight, a combination of reforms and individual action is essential to safeguard retirement security for future generations. Ultimately, Social Security's future depends on a delicate balance between bold leadership, legislative compromise, and individual preparedness. As reforms take shape, staying informed and making thoughtful financial decisions will be critical to navigating whatever changes lie ahead.